20 countries, one currency, and no exit door. That is exactly what the architects of the euro sold to 340 million people back in 1999. It was presented as a bold leap into a shared future, an economic superpower designed to rival the United States. But here is what they didn't tell you. The men who designed it knew before the ink even dried that it would tear Europe apart. This wasn't by accident, it was by math. This isn't just hindsight either. The warnings were filed in academic journals as early as 1961, in Foreign Affairs in 1997, and in classified government memos before the treaty was even signed. The euro wasn't just a flawed experiment, it was a structurally guaranteed disaster with a slow-burning fuse. And that fuse is still burning today. To understand why the euro was always destined to crack, you need to understand a concept that almost nobody outside of graduate economics programs has ever heard of. In 1961, a Canadian economist named Robert Mundell published a paper so technically dense it nearly put his colleagues to sleep. He called it the theory of optimal currency areas, and it eventually won him the Nobel Prize. It contains the single most important warning about the euro, written 38 years before the currency even existed. Mundell's insight was deceptively simple. He asked, under what specific conditions can a group of countries safely share one currency? His answer was a checklist of 4 conditions. All 4 had to be met, or the currency union would eventually crack under the pressure of what economists call asymmetric shocks, situations where a crisis hits one country hard but barely touches another. The 4 conditions are as follows. First, labor must be able to move freely between countries. Second, capital must flow where it is needed. Third, wages and prices must be flexible enough to adjust. And critically, fourth, there must be a central fiscal authority, a shared treasury that can transfer money from the countries doing well to the countries doing badly. Think of it like a nation. When Mississippi gets hit by a hurricane, money flows automatically from Washington to Mississippi through federal tax dollars, FEMA funds, and federal unemployment insurance. The dollar can survive because the United States is a fiscal union with automatic stabilizers. Now here is the brutal fact that the architects of the euro knew and suppressed. Europe met none of Mundell's 4 conditions. Regarding labor mobility, Europeans do not uproot their families and move across borders the way Americans do. There are language barriers, cultural attachments, and housing regulations. In 2009, when unemployment hit 27% in Spain, Spanish workers did not simply pack up and move to Germany. They couldn't, practically, psychologically, or linguistically. As for wage flexibility, try telling a German union that wages need to fall 20% to make the economy competitive. Try it in France. The political system would collapse before the wages moved, and the Central Fiscal Authority, the Maastricht Treaty of 1992, the document that created the euro, explicitly banned one. Member states could not run excessive deficits, but there was no mechanism to transfer money between them. There was no European treasury, no shared unemployment insurance, and no automatic fiscal stabilizers. The founders of the euro built a currency union without a treasury. They built a house without foundations and called it architecture. Milton Friedman, arguably the most influential economist of the 20th century, wrote in 1997, 2 years before the euro launched, that the single currency would increase political tensions rather than reduce them. He predicted that when the first serious recession arrived, the one-size-fits-all monetary policy would devastate the weaker economies while barely affecting the stronger ones. He predicted that the political backlash would fracture the European project itself. He was laughed at. The euro launched on January 1st, 1999, to champagne and self-congratulation. Friedman died in 2006, 3 years before his prediction came catastrophically true. But the structural flaw wasn't just theoretical, it had a specific mechanical trigger. Here is how it worked. Before the euro, if you were Greece, Portugal, or Spain, relatively poor and relatively unproductive economies, your interest rates reflected your actual risk. Investors looked at your debt, your growth, and your institutions, and they charged you accordingly, maybe 10% or 12% on government bonds. High rates disciplined government spending because borrowing was expensive. The moment these countries joined the euro, something extraordinary happened. Markets looked at them and thought, they're backed by Germany now. They have the same currency as Europe's largest, most productive economy. And so the interest rates for Greece, Portugal, Ireland, and Spain converged almost immediately with German rates. By the early 2000s, Greece could borrow at roughly the same rate as Germany, 3% or 4%. It was practically free money. What do you do when you suddenly have access to cheap credit you never had before? You borrow massively. Greece did, Spain did, Ireland did, and Portugal did. The Greek government borrowed to fund a public sector that paid pensions at 58% of final salary. It funded defense contracts that were never audited. It funded a bureaucracy so large that at one point, the Greek railway system was paying out more in annual wages than it received in ticket revenue every single year. Spain and Ireland used cheap credit to fund the most spectacular real estate bubbles in European history. Between 2000 and 2008, Spain built more homes than Germany, France, and the UK combined. This wasn't because Spain needed them. It was because the credit was cheap and the returns looked guaranteed. And here is the trap that nobody mentioned at the signing ceremony. In a normal country with its own currency, this kind of imbalance corrects itself. The currency falls, exports become cheaper, and the economy adjusts. It is painful, yes, but possible. In the Eurozone, that escape valve doesn't exist. You can't devalue your way back to competitiveness when you share a currency with Germany. You can only crush your own workers with austerity until your wages fall enough to compete. The process doesn't take years. It takes decades, and the human cost is extraordinary. Between 2000 and 2008, German unit labor costs barely moved, while Greek, Spanish, and Italian unit labor costs rose by 20 to 30%. The productivity gap between Northern and Southern Europe widened every single year the euro existed. Because they shared a currency, the South couldn't devalue to close that gap. They just fell further and further behind, financing the deficit with borrowed German money. Martin Feldstein, the Harvard economist who ran Ronald Reagan's Council of Economic Advisors, published an essay in Foreign Affairs in 1997 titled EMU and International Conflict. His argument was so dark that European officials tried to get it suppressed. He wrote that the euro would not reduce political conflict in Europe. It would create it. Forcing diverse economies into a single monetary straitjacket would generate exactly the kind of economic pain that breeds nationalist resentment. He was right. The Greek crisis didn't just cause economic pain. It destroyed the trust between nations that had spent 50 years building a shared political project. Germans called Greeks lazy. Greeks hung Angela Merkel in Nazi uniforms from protest banners. The single currency did not unify Europe. It gave Europe's historical fault lines a financial address. Greece is where the abstract design flaw became a human disaster. By 2009, the new Greek government revealed that previous administrations had been falsifying budget statistics. The actual deficit wasn't 3.7% of GDP as reported, it was 12.7%. Bond markets panicked. Borrowing costs spiked to 35%, then 40%. Default became a mathematical certainty. The IMF and European Central Bank arrived with a rescue package. But the price was something Europe had never attempted before and has never fully recovered from. Greece was forced to implement the most severe austerity program in peacetime economic history. Public sector wages were cut by 30%. Pensions were slashed. VAT was raised. Healthcare was gutted. Between 2008 and 2013, the Greek economy contracted by 26%. To put that in context, the United States economy contracted by 27% during the entire Great Depression between 1929 and 1933. Greece compressed that devastation into just 5 years. Youth unemployment hit 60%, suicide rates rose 35%, hospitals ran out of basic medicines. The Greek birth rate fell off a cliff because young people couldn't afford children. And here is the part the IMF admitted privately but said publicly only years later in its own post-mortem report. The austerity wasn't working. Every assumption the models had made was wrong. They had assumed a fiscal multiplier of 0.5, meaning for every euro of government spending cut, GDP would only fall by 50 cents. The actual multiplier turned out to be 1.5. Every euro cut destroyed 1.50 of economic output. The IMF's own internal review, published in 2013, acknowledged the program had been too harsh, that the forecasts had been systematically wrong, and that the damage was greater than necessary. But here is the structural truth beneath the political failure. None of that analysis mattered because Greece had no alternative. Without its own currency, without the ability to devalue, and without a European fiscal transfer mechanism to cushion the blow, Greece's only option was internal devaluation. This meant crushing wages and public spending until the economy became competitive again. It's the equivalent of having a broken leg and being told the only treatment is to crawl until the leg heals itself. No cast, no surgery, just pain and time. And the cruelest irony, after 6 years of austerity, Greece's debt-to-GDP ratio was higher in 2015 than it was in 2009. The medicine had made the patient weaker. When you destroy economic output to pay debt, the denominator shrinks faster than the numerator. Greece was trapped in a doom loop the euro itself had created. The European Central Bank sits in Frankfurt and sets one interest rate for 20 very different economies. That sentence should terrify you more than anything else in this video. Think about what that means in practice. In 2003, Germany was struggling with unemployment above 10% and a stagnant economy. Chancellor Gerhard Schroeder was implementing painful structural reforms and desperately needed low interest rates to stimulate growth. At exactly the same moment, Ireland and Spain were experiencing debt-fueled booms that were overheating dangerously. Ireland's house prices were rising 15% a year. Spain's construction sector had consumed an insane portion of the entire European workforce. These economies needed higher interest rates to cool the speculation. The ECB set one rate. It was too low for Ireland and Spain, pouring gasoline on their bubbles, and only marginally helpful for Germany. Nobody got the rate they actually needed. Now, reverse that situation. In 2011, Spain was in free fall with unemployment heading to 25%. The economy desperately needed loose monetary policy, low rates, money printing, and currency devaluation, all the tools a central bank normally deploys in a crisis. But at the same moment, Germany was growing and inflation was rising. Germany needed tighter monetary policy. One central bank, one rate, 20 economies, all pulling in different directions. The ECB's founding charter, unlike the Federal Reserve, does not even include unemployment in its mandate. Its only legal obligation is price stability, defined as inflation below 2%. That's it. Not growth, not employment, not financial stability, just price stability. So in 2011, when ECB President Jean-Claude Trichet raised interest rates twice in April while the southern European economies were collapsing, he was technically following the mandate. German inflation was rising, so the ECB raised rates. Spain, Greece, Italy, and Portugal, all drowning, got hit by higher borrowing costs just as their economies were already in cardiac arrest. Trichet's successor, Mario Draghi, reversed course almost immediately. His July 2012 declaration that the ECB would do whatever it takes to preserve the euro was the pivotal moment that stopped the immediate collapse. But it was also an admission, explicit and undeniable, that the original design had failed. The ECB had been forced to improvise a bazooka because the architects had forgotten to build a fire extinguisher. Joseph Stiglitz, the Nobel laureate who served as chief economist of the World Bank, published The Euro, How a Common Currency Threatens the Future of Europe in 2016. His central argument was not that the euro was a bad idea politically, but that it was implemented with a fundamental structural deficiency: the creation of a monetary union without a political union, without a fiscal union, and without the institutional architecture that any functioning currency area requires. His analogy was surgical. He compared the Eurozone to a patient given half a surgery. The doctors opened the chest cavity and then stopped, leaving the patient open on the table and calling it a success. Here is the deepest layer of the failure, the one that explains why fixing the euro requires something the founding nations were never willing to accept. Germany built the euro to work for Germany. This isn't a conspiracy, it's economic logic, and German policymakers understood it clearly. Germany's economic model is built on exports. Germany produces high-quality manufactured goods, cars, machinery, chemicals, and sells them to the world. This model requires a competitive exchange rate, A weak currency makes German exports cheap. A strong currency makes them expensive and crushes the model. Before the euro, Germany had the Deutsche Mark, one of the world's strongest currencies. German inflation discipline and Bundesbank independence had made the mark so strong it was constantly appreciating against weaker European currencies like the French franc, Italian lira, and Spanish peseta. German exports became relatively expensive every time this happened, damaging Germany's trade position. The euro solved Germany's problem permanently. By merging the disciplined Bundesbank with the chaotic fiscal habits of Southern Europe, the euro was effectively weaker than the Deutsche Mark would have been. Germany got a permanently undervalued currency relative to its own productivity. Its exports became structurally cheap against the United States, China, and the rest of the world. Germany's trade surplus averaged over 6% of GDP for most of the 2000s. In 2017, it hit a world record of $300 billion, the largest trade surplus of any nation on Earth that year. That surplus had to go somewhere. It got recycled back into the Eurozone periphery as loans. German and French banks lent to Greece, Ireland, Spain, and Portugal. The surplus nations fed the deficit nations cheap credit. The deficit nations consumed, and when the consumption boom inevitably crashed, Germany, the creditor, dictated the terms of the bailout. Ashoka Modi, the IMF's lead negotiator during several European crisis programs, described this dynamic in his book Euro Tragedy in devastating detail. The core of his argument is that the euro's design created a mechanism for transferring risk from the financial sector to the European citizenry. German and French banks had recklessly lent to Southern Europe. When those loans went bad, the bailout programs didn't rescue Greece. They rescued German and French banks using Greek citizens as collateral. The haircuts imposed on Greek pensioners were not economics. They were the protection of bank balance sheets in Frankfurt and Paris. Philip Bogus described the same dynamic in The Tragedy of the Euro, using the framework of the tragedy of the commons. When multiple parties share a common resource with no individual accountability, each has an incentive to exploit it. The euro created exactly this dynamic. Each Eurozone government could borrow at near German rates because the whole system backstopped the debt, but each faced only domestic political consequences for overspending. The incentive was to borrow and spend, while the cost was socialized across all members. It was a free rider problem baked into the architecture at the constitutional level, and everyone who had read Mundell in 1961 knew it. Here is what the mainstream coverage always omits, and why this matters right now. The euro crisis of 2010 to 2015 was not resolved, it was postponed. Italy carries a debt-to-GDP ratio of approximately 137% as of early 2026. Its economy has grown so slowly over the last 25 years that economists call it the Japanese disease of Europe. Chronic low growth, aging demographics, structural rigidity, and a currency it cannot devalue. Italian GDP per capita, adjusted for purchasing power, is roughly the same today as it was in 2000. That is 25 years of stagnation. France is now running budget deficits that would have triggered the Maastricht Treaty's excessive deficit procedure in any normal environment. Its debt to GDP is approaching 115%. The ECB's balance sheet expanded from approximately 2 trillion euros in 2019 to over 8 trillion euros at its peak in 2022. A fourfold increase in 3 years as it bought government bonds to suppress interest rates and prevent the bond market from delivering an honest verdict on Southern European debt. Mario Draghi's whatever it takes has been extended, refined, and institutionalized. The Transmission Protection Instrument, announced in 2022, is essentially a mechanism allowing the ECB to buy unlimited quantities of a specific country's bonds if that country's borrowing costs rise too fast relative to Germany's. In plain language, the ECB will print money to prevent markets from honestly pricing the risk of Italian or Greek debt. This is not a fixed euro. This is a euro being held together with central bank balance sheet expansion and the implicit promise that Germany will eventually back the debts of its southern neighbors. A promise Germany's population has never been asked to ratify. The contradiction hasn't been resolved. It has been converted from a crisis into a permanent managed dysfunction. Here is what you were sold: a unified Europe, a currency as powerful as the dollar, and a new era of prosperity built on cooperation. Here is what the documents, academic papers, classified memos, and postmortems actually show: a monetary union designed without the political architecture to sustain it. It is a currency that redistributed competitiveness from the south to the north, recycled the surplus back as debt, and then, when the debt turned bad, made the debtors pay the price for the creditors' recklessness. The men who signed the Maastricht Treaty in 1992 had read Mundell. Many of them understood the problem. Some believed political integration would follow monetary integration, that the euro would force the creation of a United States of Europe. Jacques Delors, one of the architects, described the euro as a bicycle. If it stopped moving forward toward political union, it would fall. It stopped moving forward. The bicycle is not lying on the ground yet, but it has been losing speed for 20 years, held upright by central bank interventions that get larger and more creative with each passing crisis. The greatest monetary mistake in history was not the creation of the euro. Ambitious projects fail. That's the nature of ambition. The greatest mistake was the refusal to acknowledge the failure when the evidence arrived. Instead of redesigning the architecture, European institutions doubled down. They punished the patients for the disease. They called the bailout a rescue when it was extraction. They called the postponement a resolution. You were told the euro was the future of Europe. What it actually built was a cage, too expensive to escape, too fragile to last, and too politically loaded to honestly repair. The next time someone tells you that a monetary union can function without a fiscal union, without a shared treasury, and without a genuine lender of last resort, remember Greece. Remember the wheelbarrows of unemployment statistics. Remember the hospitals that ran out of insulin while Brussels argued about budget ratios. Money is not just accounting, it is power, and the euro was designed to concentrate that power in ways that were never put to a democratic vote. The bicycle hasn't fallen yet, but it has never been further from the destination its builders promised. If this analysis changed the way you look at the global economy and the hidden structures of power, then subscribe to our channel. We are digging up the history and the economic truths that they tried to bury under layers of bureaucracy. Join us as we continue to unearth the facts. The next chapter of history is waiting to be revealed. Like this video to help us spread the truth.